Hi, I'm Gary Fabian with Coldwell Banker Realty in Summerville, South Carolina. And today I'm sitting here with Max Ballard from Guaranteed Rate Affinity, otherwise known as GRA, Coldwell Banker's lending partner. And today we're going to be discussing reverse mortgages. Thanks, Max, for being with me today. And I'd like for you to tell us a little bit about what a reverse mortgage is, how does it work, and who qualifies?
Absolutely. Thanks for having me, Gary. And very good questions. And it's a unique program that a lot of folks don't know a lot about. A reverse mortgage is simply a mortgage loan that is designed to access the equity in your home. Not everyone qualifies for it. You have to be 62 years of age or older. This is an FHA insured loan product. There are two types of reverse mortgages. One is a fixed term, fixed rate loan. The other one is called a home equity conversion mortgage, which there's a nice acronym called HECM for that. It simply works just like an equity line where you take draws over time. The difference in how that one operates as opposed to the fixed is that line that you draw off of can grow in time as your property appreciates. Year over year, that line can grow, so you have access to more funds whether you need them then or not. It's just it's a really neat product.
That sounds great, Max. Sounds kind of like a traditional mortgage, but how does it differ from a traditional mortgage? And are there extra costs and fees associated with that?
Yeah, it is very similar to a traditional mortgage, but with this, the thing that differentiates it is there's no payment required.
Mm.
So this is a way to access the equity or the cash in your property, and you don't have to make repayments. If you would like to make repayments, you can, but it's not a requirement, which is what makes it so unique. Counseling is required. You have to discuss this with a HUD counselor just to make sure everyone understands the implications of having a mortgage on your home. You pay your own taxes and insurance post closing, which is kind of a differentiator too. A lot of mortgages require that you roll that into the loan. In this instance, the homeowner pays those themselves. The costs are similar to other closing costs on this loan. There is a little differentiation in the origination fee charged, and this is outlined and governed by HUD. So HUD determines what the person pays depending on the line that they're drawing and the type of a loan, whether it's fixed or the HECM loan. So there is a little bit of differentiation there, but it's very similar to a traditional.
Okay, great. How do I get the cash from my loan, and what happens if I already have a mortgage? How does that work?
So this works just like any other mortgage, first mortgage product. If you have an existing mortgage, the first thing we do at closing is going to be to pay that loan off. So
Mm.
this becomes your one loan on your house. Like I said, there's no payments required unless you want to do that. And then the cash that you're pulling out or the equity that you're pulling out is determined, like we discussed, there's two types. There's a closed loan, where it's kind of one and done as fixed rate, and then there's the HECM, which is works just like an equity line. So if it's the closed loan, paying off your mortgage if you have one, and then you take a lump sum at the table that you can deposit, do whatever you want to with it. With the reverse, we pay off the mortgage with the HECM same way, and then you have lots of different ways to set that up. You can take it as a distribution over time, monthly, annually. You can just have a checkbook like an equity line where you write funds as you need them. So if you're traveling to Greece for the summer, you write that big check to the travel agent and then you don't touch it, or however you want to manage your money. So there's a lot of different ways
Mm.
to set the distribution of that money up.
So, Max, the last question I have for you today is how do I know if a reverse mortgage is right for me?
And that's the great question right there, Gary, because it's different strokes for different folks. No two people are alike, especially when it comes to financial situations and what they've been planning for their retirement. This is a conversation that needs to be had with your family, with your financial planner, with anybody who has influence in your life that you want to reflect back on and say, hey, I'm thinking about doing this. Let's get my mortgage person involved. Let's all sit down. Let's talk about the pros and the cons and figure out how this works. I want to supplement my golden years. I mean, that's the first question is, do I have enough to travel, to do all the things I wanted to do? Do I have enough to pay for a new car? Do I want to make car payments? So it's really looking at your budget, figuring out what the next 20, 30, 40 years of your life is going to look like, and saying, hey, I've got this huge asset in this home that I bought 10 years ago, 20 years ago, 50 years ago. How do I let that help me or enhance my lifestyle? So like I said, it's a question that needs to be approached from several different angles. I tell people to take their time, get their family involved, definitely get your mortgage person involved, and talk about it and figure out if it's the right tool for you.
Great. Sounds like an awesome program that
It
not many
is.
people are taking advantage of.
It is. A lot of people have a lot of misconceptions about what it is and what it does, and a lot of late night infomercials may have murkied the water with some of that stuff, but it's, like I said, it's an FHA insured product. You're not going to lose your home. It works just like any other mortgage, and it's a great tool for seniors.
Right.
So,
Well, thank you, Max, for joining me today. And if you have any questions about reverse mortgages or anything I can help you with in the real estate world, please reach out to me. You can contact Max or myself. Our contact information is below. Thanks again for joining me today.
absolutely. Thanks, Gary.